Best alternative for traditional banking. Banking's future is shifting. Online banks are successfully competing with traditional brick-and-mortar banks, with high interest rates, low fees, and a proclivity for digital technology, forcing the big banks, such as Wells Fargo and Bank of America, to go mobile. If you're banking on your savings to swell sitting in a traditional account, you might also be banking on disappointment. Follow along to learn about some of the best alternatives to traditional banking available today. Learning about the advantages and disadvantages of banks is the best way to go, so you can decide what kind of financial institution is best for your money. With that, here are the advantages and disadvantages of traditional banking. Advantage number 1, it offers more options. Most major financial institutions can provide all of these services in one place, whether you need a personal savings or checking account, a trust fund, a certificate of deposit, a Roth IRA, or a business checking account. Wealth management and investment services are also available from many traditional banks. Advantage number 2, convenience. Leading banks such as Chase, Wells Fargo, and Bank of America have physical locations and ATMs across the country that are free to customers. And almost every other bank from anywhere in the world has the same ATM's function system, free of use. Advantage number 3, flexibility. Customers at many banks have the option of walking into a branch to deposit cash or transferring money using their smartphones. Chase Bank, for example, competes with fintech apps like Venmo and Square Cash by offering QuickPay, a free online service for sending and receiving money via email. Only electronic transfers are available with online banks. Despite all of the advancements made in fintech, the industry still has to deal with a traditional form of currency, cash. A traditional bank is an appealing and convenient option for banking customers who deal with cash frequently. Disadvantage number 1, low or no interest rates. When compared to online banks, brick-and-mortar banks are known for offering lower interest rates on savings accounts. In fact, according to a recent geobanking rates survey, the best savings accounts were all with online banks. Disadvantage number 2, wide range of fees. You might think of bank fees when you think of a traditional bank. For example, Bank of America charges a $35 non-sufficient funds fee, whereas Alliant Credit Union, one of the largest open-to-the-public credit unions, charges only $25. Disadvantage number 3, poor customer service. According to a Consumer Reports study from 2015, one of the major flaws of large banks is that they don't understand their customers' needs or provide personalized service. According to the survey, the 4 mega banks Bank of America, Chase, Citibank, and Wells Fargo ranked in the bottom 5th of customer satisfaction rankings, holding roughly 40% of all U.S. commercial bank assets. Smaller financial institutions have a smaller demographic, but this appears to help them learn more about who is banking with them and what they want. Now, we will tell you about 7 alternatives to a traditional bank account that could bring you quicker and better results. Number 1 on our list. High-yield online savings accounts. Savings accounts at local banks pay almost no interest. Online banks can offer you much better rates. HSBC Direct and CIT Bank are 2 companies that excel in this area. They offer interest rates on savings and CDs that are well above 1%. Online banks have the disadvantage of not always providing full banking services. Some people, for example, do not have access to checking accounts or ATMs. Others refuse to make loans. For pure savings, online high-yield savings accounts are the best option. In most cases, it will be necessary to maintain your relationship with your local bank while earning more money on your savings online. Number 2 on our list. Treasury Securities. Although most people are aware that Treasury Securities exist, only a small percentage of people invest in them. This is unfortunate because some types of U.S. Treasury securities pay very high interest rates. Furthermore, because they are issued by the United States government, they are regarded as the safest of all investments, virtually immune to default. Treasury securities in the United States are classified in a number of ways. Treasury bills can be 30 days to 52 weeks long, Treasury notes can be 2 years to 10 years long, and Treasury bonds can be 30 years long. Treasury bills pay lower rates because they are short-term, but they are still better than a traditional bank. Treasury notes, on the other hand, can provide higher returns if you are willing to invest for a longer period of time. They are available in as little as $100 denominations, and pay interest every 6 months. 2-year notes are currently yielding around 2.5%, while 5-year notes are yielding around 2.8%. You'll be tying up your cash for a longer period of time than you would in a savings account, but the higher interest rate may be well worth it.
Before going on, if you feel that I have given you some value, Please help me by smashing the like button, subscribe to my channel and turn on the notification bell, so you will be updated when I upload new videos like this.
For instance, Treasury Direct allows you to buy, hold, and sell U.S. Treasury securities. Number 3 on our list. High dividend stocks. Stocks, of course, carry a higher level of risk than traditional savings. If your primary goal is to build an emergency fund, they're not the best option. There are plenty of good high dividend stocks if you want a higher yield on your savings, as well as a chance of price appreciation. A list of dividend-paying stocks can be found on Nasdaq.com, and many of them have yields of over 5%. Many of these businesses are well established and have lower volatility than the stock market as a whole. High dividend yields, in fact, tend to provide some protection during market downturn. There's also a bonus here. If the company's dividends are classified as qualified dividends, there may be no tax liability. We recommend Ally Invest, an online discount broker, to get started buying dividend stocks or any other type of investing in financial markets. It will be simple and easy to get started because they have low fees and no minimum deposit. Number 4 on our list. Municipal bonds. Over the last 5 years, the average annual return on municipal bond funds has been around 3.5%, according to Morningstar. This is significantly higher than traditional bank account yields, as well as many of the alternatives discussed in this article. The best part is that interest earned on municipal bonds is tax-free in the United States. If your state has an income tax, and the bonds are issued by a state agency, the interest will be exempt from state income tax as well. This is referred to as double tax exempt. Because bonds are tax-free, a bond yielding 3% will be the equivalent of a 4% return on a taxable investment if you have a combined marginal tax rate of 25%. A municipal bond fund is usually the best option for small investors. This is because the fund can invest in a variety of bonds. They may even be sorted by state, allowing you to benefit from dual tax-exempt status. Number 5 on our list. High-yield bonds. Corporations issue these long-term securities. They can last for 20 years or longer, but they pay much higher interest rates than traditional banks. In fact, according to Morningstar, high-yield bonds have a 5-year average return of around 3%. Individual bonds are usually sold in $1,000 denominations. Some may even demand a $10,000 minimum purchase, 10 bonds, making diversification difficult for small investors. A high-yield bond fund might be a better option. The iShares 0 to 5-year high-yield Corp BD ETF, for example, has a 1-year return of about 3.5% and is made up of bonds with maturities of less than 5 years, making it less risky than long-term bonds. Number 6 on our list. Real estate investment trusts. When it comes to saving, few people consider real estate. However, there is a way to use real estate as a high-yield savings vehicle. REITs, or real estate investment trusts, are similar to mutual funds that invest in real estate. Retail space, office buildings, warehouses, and large apartment complexes are all examples of commercial real estate. Dividends are paid by REITs. In fact, they are required by law to distribute 90% of their profits to their shareholders in the form of dividends. Over the years, the returns have been generous, averaging 10% per year. Because REITs are also publicly traded funds, you can buy and sell them at any time. With REITs, there is a risk of losing invested capital, so make sure you're aware of this and ready to invest for the long haul. However, it is a way to earn high dividend yields without being so reliant on the underlying investment's price fluctuations. Number 7 on our list. Peer-to-peer lending. This is yet another type of investment that entails some risk. You invest in personal loans issued to consumers through peer-to-peer lending. There is always the possibility of a loan defaulting. When you invest in P2P lending, however, you're only buying notes, not whole loans. Individual loans in the amount of $25 are represented by the notes. With a $1,000 investment, you can put your money into 40 different loans. This will help you to reduce your risk. The profits from peer-to-peer lending are impressive. Lending Club claims that average returns range from 4% to 6% per year, but many people are reporting much higher returns. Community and local banks. Community banks are a vital part of many areas, especially rural and farming communities, which depend on local banks for loans and basic services. Because these areas are usually tight-knit, these types of banks are more flexible with loan requirements than big banks. For example, the Independent Community Bankers of America Association says it considers character, family history, and discretionary spending in making loans. This is not the kind of service you could typically expect to find in a big, traditional bank. Regardless of your banking preferences, the FDIC advises consumers to confirm the bank's legitimacy and that all deposits are federally insured. The FDIC maintains a public database of all insured banks, allowing you to quickly determine whether your bank is protected. And whether you go with a traditional bank that offers online banking or an online-only bank, be wary of copycat websites that use a web address that looks exactly like a real bank's to entice unsuspecting customers. What do you think with our list? We would love to hear your thoughts about it on our comments section below. If you learned something from this video, please do not hesitate to give us a like, subscribe and hit the notification bell to keep you updated from our more upcoming videos like this. We could only hope that you will find the right way to keep and invest your money. Thanks for watching and see you on our next video.